Welcome. Good morning, good afternoon, good evening, wherever you are, to the July meeting of the Indicio Identity Community Meetup. We'd like to start off thanking Indicio for promoting and supporting us in creating these events. This is part of Indicio's public benefit mission to advocate for and educate about decentralized identity. So these meetings are an opportunity for folks to come together, learn about a topic, a particular vertical, a particular implementation of verifiable credentials and decentralized identity, and to ask questions. So just a couple of notes. Again, my name's Helen Garneau. I should say I do marketing at Indicio. And we have a great panel today to talk about financial services and verifiable credentials in financial services. And we'll also have a demonstration to show what that looks like with reusable KYC specifically, and how that can be used to help alleviate some of the friction points and provide better experience, user experience, security, privacy, all those good things. So we'll touch on all of that today. So a couple of housekeeping notes for those that are joining. First off, this is conducted as a Zoom meeting, not a webinar. So meaning that you're free to ask questions, talk, amongst yourselves, come off mute and ask questions if you'd like, come off, turn your camera on or whatnot. So we're really happy to try to enable that kind of cross conversation as we go. But with that said, if you are not asking a question and you're just observing, we'd appreciate it if you just kept your microphone off and your camera off as to not distract the conversation for everyone else. We are recording this, and like I said earlier, this is being live streamed on LinkedIn as well. So we will be monitoring that as best we can to get questions from that group as well. And we're recording it, and we will post it on the Indicio YouTube channel, hopefully either later today, whenever it's available for us to post. We'll put it up there, and then please feel free to share it with your friends and family and whoever you'd like. So with that said, I'd like to introduce our panel today. So today we are very, very honored to have Dan Gisolfi join us. He's one of the co-founders of the Trust Over IP group at the Linux Foundation, and he is also currently the Director of Development. Dan, what's your official title at Discover these days?
Distinguished Engineer Director of Research and Development.
Research and Development, awesome. And then we also have Ken Ebert, the CTO here at Indicio. He will be doing the demonstration. And then Trevor Butterworth will be leading the conversation and helping us get through the next hour or so of conversation. And he is a VP of Communications and Governance at Indicio. So with that said, I'm going to turn my microphone and camera off and stop sharing my screen, and I will pass it off to you folks. I just asked that Trevor, if you give me maybe 5 minutes at the end, we'll take questions. Like I said, take questions throughout the hour. We will also, afford some time at the end as well for dedicated Q&A, and then just a couple minutes at the end so we can talk a little bit about the August meetup, which is coming up, which will be a great conversation about Zero Trust. So with that, I'll toss it to you, Trevor.
Okay, well, I don't need to waste any more time with discussing formalities. If you want to ask a question, either raise your hand or write it down in the chat during the conversation. We'll address questions as they come. We won't wait till they're all at the end. Without any further ado, I'm going to hand it over to Ken to explain what we're about to see in this demonstration of reusable KYC credentials.
Okay. Are you able to see the screen?
Yep.
My controls say I'm sharing. Good. So what we're going to see is a brief demo, fairly simple. It's showing 3 participants. The participants are Mountain Banking, a fictional banking website, a bank customer, Sarah Ann, who's going to open an account and then apply for a mortgage, And then a bank partner organization, an independent insurance company that's partnered with the bank that's going to be offering some insurance products to Sarah Ann as well. So if you look on the screen on the left, we have the banking website, and you can see that it's a website that allows for creating an account or logging in, the typical types of things you'd want to do with a bank. On the right, we have Sarah Ann, and she's using her credential, her driver's license credential that she's received over here, that she either got in app or that she's used with relationship with the DMV or the motor vehicle department to get her driver's license. So that credential's already in her wallet. She's now going to try to apply for her opening an account. The bank is going to, as she clicks on open an account, it's going to display a QR code. The purpose of the QR code is to connect Sarah's wallet with the proven agent that the bank is using. She scans that code, and that establishes a secure DIDCOM connection between the two parties. The bank is then requesting her driver's license credential. Her driver's license credential is in her wallet, and Sarah can choose to view the details of what they're requesting or simply apply to accept the request and share that driver's license information with the bank. Driver's license has name, address, date of birth, things that are really useful in establishing an account, a minimal account with the bank. The bank has received that credential, and now it could be automated to open the bank account. In the demo, we're going to show a manual process that allows the bank to take whatever steps they're going to and either supply that information via API, or in this case, through the connection that they have with the bank, between the bank and Sarah, to offer that data. So the bank account credential in this case is we're populating a form using demo data, and then that's going to be offered to Sarah that over that same secure DIDCOM connection. So the credential offer is being sent to Sarah. She receives that offer to receive a credential, accepts it, and then the information is going to be transferred from the bank to her wallet to provide her with that bank account credential. And that credential contains information about her and the account information and details that might be pertinent to that particular account. Sarah is able to hold that in her wallet, and then she can choose where and when she wants to share that, and or delete the credential at any point in time that she wishes. Once the data is in her wallet, it's completely under her control. The bank can revoke the credential at any time, or update the credential and revoke the old one and give her a new one. They also at some point offer her a KYC credential. They may have done some additional gathering of information on her credit background, on proof of employment, any of that type of information that's part of the normal banking KYC process for establishing a mortgage, for instance, might include proof of employment or other types of information. Sarah has now been offered both of those credentials. She has a KYC credential in her wallet. She has her bank account credential in her wallet, in addition to the driver's license. And now Sarah comes back later and wants to log into the bank. She clicks log on. The QR code offering to connect her to the bank and request her account credential is now being presented. If Sarah scans that QR code, she's able to connect to the bank. And this time the bank is going to request her account credential in order to prove that she is who she says she is, so authenticate her, and also authorize her to view that particular account. And Sarah chooses to accept that offer to share the information, and the account credential information is offered. Well, that's fun. This is not part of the demo. This is an ad. So once she's sent that information to the bank then can display to her the account balance information, any pertinent details, and allow her authorize her to interact with her bank account in any way that is appropriate, given her identity has been confirmed and the account details have been confirmed. Sarah can also take the information that she's received and interact with a bank partner. In this case, Triple Check Insurance is a partner of the bank. They've perhaps negotiated to give special rates or offers in the insurance products to the bank's customers. Sarah is going to use her KYC credential, which has a substantial amount of information that has been gathered, and offer that to Triple Check to expedite the onboarding process with that party. Sarah's information that was collected doesn't have to be repeated, whether that's with another division of the bank to repeat KYC all over again, which is painful for the customer and expensive for the bank. That allows the process to move forward more rapidly and allow Sarah to quickly establish her identity and move into a relationship with the insurance company. The bank information that they encoded into the credential is trustworthy based on the data that's in the credential. The Triple Check can verify that it came from a trusted source, the bank, and they can prove that the data hasn't been tampered with by the customer or anybody else along the process, and they can therefore make a business decision relying on that. So Triple Check displays again a QR code, which allows for the connection, the secure connection, to be established, and then they can request type of credential. They may request the driver's license. They may request a KYC credential. In this case, we're going to have the bank credential on KYC be requested from Triple Check. So as Sarah is in this process, using that secure DIDCOM connection, the request is sent to please provide your KYC information. Sarah accepts that and sends that data over. Once the data has been received by Triple Check, they now can make particular offers customized to Sarah's particular situation, auto, home, life, whatever the type of offering that might be involved there. And this allows for a much smoother transition for the customer and a better experience for Triple Check and a cost savings to them. They may have negotiated discounted insurance rates and also benefit from the reduced cost of KYC because they can trust some of the KYC done by Mountain Banking. I think that's the end of our demo. It's pretty exciting to see the smoothness of user experience that can be achieved and the ability to quickly share very trustworthy data over those encrypted channels between the bank and Sarah and between Triple Check and Sarah. So it allows for a much better user experience with trustworthy data. Trevor?
Thank you, Ken. So my question for you, Dan, is what is the business case for banks and financial institutions to start using KYC credentials or using verifiable credentials in general for accounts or what have you? What problems are they solving that make business sense for adoption?
Thanks, Trevor. Yeah. So first of all, Ken, great demo. It's a discussion starter, and it's definitely shows the art of the possible. The real barriers are, how to bootstrap the environment or the ecosystem to let these scenarios that Ken has outlined possible. But to your question, Trevor, why would this be important? So there's a couple of factors. One is fraud protection. Second is customer sat. And also making sure that we have, from a banking perspective, addressed regulatory requirements. So let's talk about the customer sat one first. We've all, as individuals, have gone through the pain of KYC processing over and over, right? You establish a bank account, Now all of a sudden you want to get a credit card, you have to go through the same questions over and over. Why? That's very rigid. There's a lot of friction. It's wasted time on both sides. And from the bank's perspective,
it's error prone too. And when I fill out all those forms over and over again, sometimes I finger my account numbers or my address, it comes out a little bit different than it did last time. So if I can avoid the having to fill out the form, the bank benefits from me not having to fill it out again, because I'm not as reliable as the scanning my driver's license it would be.
Right. But it's not just the driver's license, because the KYC process is, everybody focuses on the driver's license. It's much more than that. And as you go downstream into the KYC processing, depending on the services you're going to require from the financial institution, there's more information that has to be collected.
Right.
And so the cost of, during the KYC process, the bank is verifying, doing multiple different verifications, often causing or calling external services and paying those services for the verification. Why do it multiple times? That's cost reduction possibility. So we can improve on cost for the KYC processing. I love the demo aspect that we show KYC being done, and then the financial institution issuing what we call the KYC credential.
Right.
But essentially, that is saying is that the bank has attested. Let's just say that the initial onboarding was the driver's license and a proof of employment, so 2 verifiable credentials, okay, from 2 different issuing institutions. If the bank at that point had verified that information and then issued a new bank credential that had the aggregate of that information, now that aggregate credential is an attestation from the financial institution that they've already done KYC verification. That has extra value into the ecosystem once we get there. Back to triple check, right? The insurance company, if they want to now check it, they're not just seeing that this information was available, that there's actually indirectly known to the insurance company that a financial institution has already done the KYC and has attested to them doing so. That's a value to the system if we can ever get that, right?
You mentioned that they have the driver's license and maybe a proof of employment as a credential, but they may have done a bunch of other really complicated steps that involve looking at pieces of paper or a deed of a property or some other bits of information that may not be in a verifiable credential format. But once they've verified it and they've done their work on it, now it can be put in a form where it's consumable by the other divisions of the bank or the external partners, as you mentioned. And that data might not be in a form was readily available as a credential, and now it can be put in or included in that KYC credential that you talked about. So both direct issued, government issued credentials, derived credentials from paper documents, or the manual processes of KYC. It doesn't have to disrupt those processes of the KYC process. You can just have additively at the end of the process issue that credential that contains that information, and that encapsulates it in a way that can be readily used in other departments within the bank or externally.
Yes, spot on, Ken. So I know this is leaping way forward, but if you think about it, if the financial institution did the KYC and the attestations and all that work, and they paid for doing so, they're actually helping downstream the insurance company that may not have to do it because now they're trusted. So you can think about in the future, the issuer of those credentials that perform the KYC, there's value to that KYC credential. It may not be a free credential, right? Because you've actually provided something that can be used by others to avoid the costs. But there's a lot that, I'm just trying to peel the onion what the art of the possible here is, but to bootstrap the environment. So we talked about the
you've hinted at monetization. You've hinted at monetization, and we're not going to talk about going to great depth on that. But I think that is interesting because it may be of value to the consumer, or it may be invaluable to the external parties, and they may
from a B2B. It's definitely a value.
Yeah, let's. I'm sorry to interrupt you.
No. So monetization is there, right? Well, that's another thing to peel back on. But the other part is fraud. So today, fraud at all institutions, not just the financial, exists. I mean, this has been being, this topic's been beat to death on the use of passwords and the risks associated with it. As you saw in the demo, once that initial onboarding is done, and the bank can now, by policy, change and say, I'm not going to request a password. If you are an existing customer and you have a credential, I'm going to ask for that as my policy for you to sign in. Now I have a higher level of assurance that Ken is who he says he is, right? Because we've already vetted it. It's one of our credentials. And there's, it's going over secure DIDCOM connection and all that goes with it. That has that by itself reduces fraud, right? Now, when we talk about, in this case, just onboarding and password this authentication there, but what happens if you were to call into a call agent and you now had a digital credential? The fraud of protection of actually knowing that it is Dan calling and he has been vetted and he has a way to demonstrate that he is a client of the business of the bank. That's actually more protection for fraud protection for the call agents. So back to Trevor's question. There's the fraud. There's customer sat. Now regulatory.
One more part of the fraud thing. I think that my mother-in-law gets calls from scammers all the time. How does she know that she's talking to the real bank or that she's talking to a scammer? So in the case of DIDCOM connections in particular, you can mutually authenticate. So that not only does the bank verify that I'm the caller, but I can, with my app, know that I'm actually talking to the bank and that I'm not talking to fraudulent operation trying to fish my data out of me so that they can take over my account. So I think that mutual fraud prevention allows for increased protection and for the consumer and for the bank. So I think it's really an awesome addition to the fraud topic that you brought up.
And if I may interject, verifiable credentials also provide a line of defense against deep fake phishing, which seems to be, call centers and financial call centers seem to be on the front line of, the sort of generative AI attacks in order on the new wave of identity fraud. So it would seem that also is the benefit, a huge benefit. But and let me pause for a moment and say there are questions on the demo in the chat, so you may want to address them either verbally or in the chat. But I want to ask a follow-up question to Dan, is that, so these are really compelling business use cases. So what are the blockers? Is there a compliance blocker in the sense that, well, we know that we can justify our inefficient and costly and ineffective KYC processes, but this new technology is new and we don't know how to justify that on a compliance level. Is that an issue? Is that a blocker?
I really feel that one of the main inhibitors is regulatory compliance. So just think about it. Financial institutions are, as well as all enterprises, they're smart people. They know that there's other ways to solve the password problem. But to remain compliant, the regulation hasn't caught up to the tech, and the biggest risk especially in the financial sector, is being out of compliance. So that has to be first and foremost, remaining compliant. And if the regulations don't address the tech and the evolution of tech yet, it becomes a harder problem. It becomes an inhibitor. That's why I really believe that some of the push that's going on in the EU around digital credentials is going to open up doors, because that's going to break down the barriers, but it will take time. But still, adoption is going to. I think that's part of it. The other part is bootstrapping the ecosystem. We can't, as we just talked about, you can't just make this possible with one credential being a driver's license, right? That's not enough for the KYC processing that's required. You have to have other credentials out there. Now, to Ken's point, early on, you have to use some of the existing paper-based processes that are used for KYC to be used to generate bootstrap the first credentials for you. But once you get some of those into the wallets, things will happen. We've spent a lot of time on wallets and the discussion on wallets and the underlying tech. Folks, if we don't get the actual digital credentials, the verifiable credentials out there, you're not going to be able to start looking at some of the use cases and breaking down some of the barriers and proving to the regulatory and compliance concerns that this is viable. I think there was another question. I see a hand.
Kyle, I think, was a thumbs up from Kyle. I'm not sure that was a question.
That was just a thumbs up for the regulatory compliance comments. I'm in the same boat. Totally agree.
And well, how do we? I mean, how typically do financial institutions advance on that? I mean, there's a bit of a chicken and egg here. I mean, they have to see the value in the credentials in order to press the regulators to pay attention to the credentials in order to use the credentials. So, I mean, does it make more sense to address, the call center fraud issues with credentials first and then move to KYC?
What you're really asking is, what are some of the use cases that are less regulated to bootstrap model to get things going? I think that's an approach to take. Is that with call agents? Possibly. I think to Ken's earlier point about some of the KYC workflow where there's paper required. I mean, some of that is being attempted today without paper. So in some financial institutions, you go to onboard, you're given an option to, well, let's leverage an existing aggregator, whether it's Plaid, MX, or others out there, to connect to other banks to provide information so that when you're going through the KYC process with your new institution, they don't have to require the uploading of paper documents for verification. But what we're seeing is that experience from consumers is often not well accepted, and it's avoided. They start down it, and then there's a trust factor, and then they end up going down the paper-based process. So to me, that tells us that we need to, when you're entering in a third party, like an aggregator there, that adds a trust concern to the user experience. And how do you address that? Well, maybe it's the wrong approach. Maybe that's where, if they were able to go and obtain their own digital credentials in their own way, get that KYC process done, digital notaries, or maybe going to a brick and mortar bank to get it actually, some people where they face to face, where they trust, and get a credential issued to them, then all of a sudden they can start working in the environment, right? The analogy is, we get a new credit card today, right? It's you have a relationship with the bank, whether you do it online or whatever, you get a new credit card, it's mailed to you, you now have this physical item, right? And now you go and add it to your wallet, okay? And now, because you add it to your wallet, you can participate in all of the electronic, peer-to-peer transactions with your wallet. How do we leverage that same model for identity? How can you go get the necessary identity credentials, KYC, minimum KYC processing from some physical institution to get you onboarded? Again, so what are the early use cases? Maybe agents to start this off that are not regulated as much, but I don't know. I don't have an answer for that.
When the KYC is shared within the same institution, I think that the regulatory compliance can be argued that it's met without having to extend it, across institutions, where you say, yes, the bank did do the KYC, a different division of the bank can rely on that information. And here it is easily, readily collected and given to in a form that can be reused to the end consumer. That's a first baby step towards reuse, and allows for a fairly simplistic model that can comply with regulatory framework.
Yeah, it's a good point, Ken. I mean, being able to, as a financial institution, state that when I've onboarded Ken, I can attest that I have evidence of the information that was required for the certain services that were being provided. So that evidence is something that auditors look at, right? Where they can come in and say, "Can you prove you have evidence for this?" And so, what's wonderful about a verifiable credential is that once it is offered and consumed, then that information can be, integrated into the back end of the bank and said, "Oh yeah, the source was a digital credential. And you actually have it in the demo. There's information about the digital credential, right? That ties it, binds it, that you actually vetted it, and it bounds it to who actually the issuer was, right? And if you want to follow this through, like, digitally, who was the issuer? Is it a trusted institution? We can gather that information. You have now evidence. But the question back to Kyle or whoever else asked it, is that acceptable with the auditors? That's really maybe we should be having conversation with some auditors and saying, what do they feel is some of the inhibitors of using this for evidence, KYC evidence?
I want to just point you in the direction of a question in the chat from Andrew Fisher. Can someone comment on California's use of verifiable credentials through DIDs as driver's licenses? Are banks in California using transferable KYC using VCs as the source document?
I don't know if we can make that statement about banks in general, whether it's in California. I don't know any bank that is using a verifiable credential today.
So
I think that the credentials are fairly new and recent, and I think the time to adopt them as part of the KYC process is still in its infancy. I know that I now have the ability to have my driver's license in my wallet as issued directly from the state of Utah as a MDL, as a credential in that form. But the use of right now, they've issued them, and they have about 5 places where you can actually get them verified and use them that way. And they're trying to promote the use and adoption. But I see that as now that the chicken has laid the egg, now we have to see how to hatch them and get more and more people able to verify them. And the financial institutions are, there are 3 credit unions in the state of Utah who are now accepting the driver's license as a form of identification to establish who I am. So my identity establishment. So I think it's just getting started, and I think you'll start to see more and more institutions adopt as they become aware of it, the advantages of using it.
I think folks should step back and learn from the physical world, right? So go to a new bank, and try to open up a bank account. What are you required to do, right? Don't even do it online. Just go to your local credit union or something. They're going to ask you for your driver's license, okay, just to bootstrap it. But what you will find is that you can get an account opened up minimally, but by itself, you may not be able to do certain transactions. You may have to do, if you want to do an ACH transaction, you're going to have to do more KYC down the road. And by the way, we've seen that causes customer friction as well, because customers think, oh, I have an account opened up, but you really haven't been vetted enough to do all the services that you want to take. So that the current model is they postpone some of the KYC processing until later, but that adds user experience problems, right? And customer sat problems. So I really think, big fan of design thinking. And what we lack here is actually doing some of the necessary design thinking exercises to show that what is required up front, right? Just good enough KYC to get a breadth of services, not minimal services, the breadth of normal services that people expect when they first open an account. That's going to tell us what credentials are needed. And I'm a big advocate that driver's license alone is not it. We've been going down this model for over 12 years, if not more, around, the MDL is the key to the kingdom. I'm sorry, I don't believe that's true.
I think it's the first step on a journey. And I think what I think you've suggested, Dan, is that there for regulatory compliance, there might be multiple levels of KYC that are required. A minimal one to open, say, a savings account, something more rigorous to have a credit card, something more rigorous to wire money to another country. Those are is that an accurate assessment, or am I misreading it?
No, that's spot on. I mean, there's actually stories out there where people go into a bank and they log in to or onboard to a bank, and they transfer money into the account. Then they go try to use it and they can't. Why? Because there's more downstream vetting that has to be done, and their expectations were not, that wasn't so. And if when you feel like, oh, I can't use the money, it's my money, well, that becomes problematic with folks, right? So it's not just about tech. We have to focus on what that user experience is in conjunction with the regulatory requirements.
Dan, Kyle has a question. Can you comment on the requirements for unique identifiers and credentials/presentations to meet AML regulations?
The answer is no. I'm not going to go. I would have to go dive into the key point there is it's AML regulations. So each regulation is going to require different information. I mean, can you elaborate on the question a little bit more?
Sure. So I'm working with the BC government in Canada, and we're working on meeting FinTrack requirements, which are the Canadian financial regulations. And one of the regulations in Canada, at least, is that when you're presenting yourself to a financial institution, you have to present with a unique identifier that can basically be tracked across multiple places. It gets into like your credit score kind of areas, mortgages, so you're the same person with the same number in a number of different places. And that's one of the reasons is to meet the anti-money laundering regulations. So I just wondered what kinds of things you see in the United States about that.
So in brick and mortar, non-digital here is like the analogy to a social security number. Is that what you're talking about as an identifier or something?
Yeah.
Yeah. So when we go to the digital model, we don't want to be sharing that kind of information, right? That we want to mask that. So what would be acceptable for the regulators? This is what I'm saying. We really should be sitting down, right? If I was working for a tech vendor in this space, I think a real important exercise would be sitting down with the auditors. Sitting down with auditors and understanding what as we transition to digital realm, what would be acceptable for AML? What would be acceptable for going in with the banks and to pass something as starting a bank account, onboarding a bank account to address some of the regulatory requirements? We have to. I mean, I think Kyle, you asked the question earlier. The regulators. This is to me one of the biggest inhibitors for the financial institutions.
Well, Dan, they may be inhibited, the regulators, but we're also looking at the juggernaut. Gartner, in fact, addressed in its latest market report on decentralized identity, notes that very soon the 500 million people are going to be making verifiable presentations on claims, largely due to the European Union's advancement on decentralized identity. Now, maybe for regional banks and financial institutions in the US and North America, that may not be urgent, but it's potentially urgent for any bank that has international business. So how do you think that's going to
I love it.
Sharpen people's awareness and get people moving.
So unfortunately, we live in a reactionary world, right? And we saw the same thing happening in GDPR, right? With PII. As soon as GDPR came out, all of a sudden, even companies in the US had to become compliant with that. So now that's the forcing function to say, wait a second, we need to look at this, right? As opposed to be getting ahead of the curve, they're waiting to react. And I think that's exactly what's going to happen here. You're spot on. As soon as these credentials get out there in Europe, now what's going to happen, right? What are companies going to do to address some of those changes? But to Kyle's question about AML, I don't know if that's going to really address that yet, right? I think that's a bigger problem.
So Dan, as we look at the prospect of leaping wholeheartedly into verifiable credentials, is there a baby steps approach that might be more acceptable or manageable for the financial institutions, or what do you think?
I always thought that as the demo depicted, passwordless auth was low-hanging fruit, because it helps bootstrap and get the credentials in there, and it addresses the password problem that we all know is problematic. We all see the constant hacks that are out there. If we can reduce the use of passwords, getting accounts hacked would be reduced. There's a lot of money and a lot of pain. Think about it today. I mean, just I would say over the last month, I think there was AT&T. Wasn't they hacked recently?
Yep.
I know in our area, one of the healthcare companies was hacked. And you get the mailers at home. Oh, your account's been part of the this hack, and like, what do people do? And think about the cost just to deal with the hack. We're not thinking about. We're constantly putting band-aids on the problem and not thinking about the solution, right? And so to Trevor's question, I really believe what's happening in Europe is going to be a forcing function, because we're going to have to face a new approach, right? They're seeding the market, and that's good.
So even if we were to start with the passwordless login use of credentials as a mechanism to get the software agents in place, both for the financial institutions and the holder wallets, so that they can hold a credential and do something useful with it, bake it into the banking apps to be able to make it more seamless, so you're not having to carry around a external wallet and then have a banking app that's separate. That might be a good place to start. And even if it doesn't 100% replace all the usernames and passwords, I think it will be a migratory effect that would allow some users to start using it and then others to get on board.
So I totally agree. And so looking around at some of the people that are on this call, why did vendors go down passkeys and doing passkeys? This technology leapfrogs that. Why spend the time, right? So now financial institutions and other enterprises, customers of vendors, are sitting back and they're trying to adopt passkeys. Well, that's going to take another couple of years, right? Meanwhile, we're not solving this problem, right? And now we're going to have to, then the vendors are going to go back to the same customer and say, oh, you know what's happening in Europe? You're going to have to address this. Well, you just had me do passkeys. Poor planning. I'll leave it at that.
Well, we are closing in on the last 15 minutes. So please, if anybody has any questions, now's the time to either raise your hand or write them in the chat. But we've talked about, sort of bootstrapping this environment and the challenges and the opportunities. But I want both of you to, sort of take out your crystal ball and think about, okay, so we bootstrapped. What happens? What's the future? I mean, in any technology, there's the immediate use case, and then there's the adoption, and then the adoption triggers realization of, oh, we can use this to do X, Y, and Z. And then, well, we can also use this to do things we never thought we could do. So what does a decentralized financial world look like with verifiable credentials? as opposed to, say, crypto?
I mean, I just think it goes back to your original question about in the 3 points. Reduce regulatory compliance for the banks, right? Better customer experience, and the potential monetization that we have that would be there that can be opened up. I think that's an untapped environment, but very futuristic question. But again, we've been talking about, there's many folks on this call have been in this space for 10, 15 years and trying to get this bootstrapped, and we started out there. We should all step back and ask, what are we doing wrong? Right.
Well, that's also speaking as, as an American resident who spends time in Europe. It does seem to me that, the open banking revolution has sort of taken off in Europe in the way it hasn't taken off in North America. How might, so maybe, again, North America might be the laggard in all of this, but where would verifiable credentials take open banking?
Well, first of all, let's look at the example that I was talking about with the APIs related to, the aggregators, MX, Plaid, and there's a few others, right? So digital credentials could be used there. And that the friction I was talking about, if anybody has been through the user experience, when you're actually going through as you're one financial institution and you're going in and being connected, you don't even know who the aggregator is till you obviously see this logo and you're like, who's this third party? Why am I being asked to consent to give information to this third party who's then going to aggregate to your other institutions? Well, what if that experience was improved by the fact that you are offering your credential, right, in a secure way, in a manner where your information is not all revealed, and with your consent, maybe that experience gets improved. But that would benefit the aggregators. But for open banking, that to me is an inhibitor. The digital credential could be used for the APIs there.
I think you need to look at things in an evolutionary point of view. It's not, I don't think it's going to be an overnight revolution. I think it's going to be, how do you improve a particular process? How do you improve login at the bank? That's the simplest one. How do you improve the customer call center experience? How do you improve applying for a new product, the KYC? I think that's a little bit more complicated because you have the regulatory aspect of it. But I think you're going to see additions to existing process, not replacement. You're going to see, I can now log in using a credential instead of having to have a password that I rotate every 90 days and forget and have to write down on a piece of paper and stick on a yellow sticky note on the screen. I think about how to improve those processes, make them more secure, make them more reliable. How does biometrics play into this? Are they able to recognize my face when I walk into the branch because I gave them my credential, and then the credential has a picture of me, and then the teller can see my picture? It doesn't have to be automated. It can be a visual comparison or something like that to give higher assurance that the right person is there at the right time. But I think those evolutionary steps to add more security, add more smoothness to the process, to make it easier to talk to the bank over the phone, or to request a particular service that might need a little bit more assistance, or a complicated process like getting a mortgage. Those things can be assisted initially, and then gradually over time, more and more of the process can be accomplished with verifiable credentials and things like DIDCOM messages. And I think that's the way to look at it, to get it to go where it needs to go, but a smooth, small step at a time.
One other thought here is that your question, Trevor, was focused around financial sector. Because of the high regulatory sector we are, will the digital identity future really be started, or early adopters occur in that sector? Places like entertainment, right, retail, may be clearly less regulated. Maybe the way to get some of this bootstrapped. But from from the KYC perspective, finance is a key place where KYC is required, and it's not so much in entertainment.
So just a couple of notes in the chat, and before I address them, just want to ask Tim are there any questions on LinkedIn that we need to address? But first, this is Yasin has, will we receive a copy of the recording of this call? This meetup will be posted to YouTube, so you'll be able to share a link very shortly. Audrius says, for the discussion, it's important to have the same understanding of what we mean by KYC. In EU regulation, KYC is much more than just personal identification. It is also information if the person is in a sanctions list, is the person a politically exposed person, et cetera, et cetera. So very useful, important additions to our conversation.
But spot on, none of that information is in your driver's license.
Yes.
This is my point. Right?
Yeah. Any other points is there anything else you'd like to say to sum up, Dan or Ken, before we hand it back to Helen to talk about the next month's meetup?
For me, thanks for the opportunity. Great conversation. I look forward to having more of this.
I'm excited to see the adoption at whatever pace it comes, slow or quick, and the improvement in customer experience and the reduction in fraud for the financial institutions and for the customers. Excited to see some cool stuff coming.
Excellent. Well, thank you both for a really interesting conversation. As I said, this meetup will be posted on YouTube very shortly. So you'll be able to relive this, ponder on it, send it to colleagues, proselytize it across social media. Thank you for doing so. And with that, Helen.
Wonderful. Thank you all so much for such a great conversation. I will just say one thing, that I always like to joke that I'm in this business with verifiable credentials and decentralized identity for purely selfish reasons, because I never want to have to fill out my name and address ever again on any form, at least very few forms. For somebody who's moved a lot in the last decade or two, I've remembering the last 7 addresses I've had takes a mind that is not as sharp as it used to be. So I'm looking forward to being able to digitally show this information, because as Ken said early on, transposing address numbers and things like that is very easy to do. So very excited for all the kind of enablement and user experience this will provide. So back to what is happening in August. So our next meetup will be taking place on August 27th. One of the preeminent thinkers and original scholars behind the Zero Trust framework is going to join us, Dr. Chase Cunningham. If you haven't followed him on LinkedIn, I highly, highly suggest you do. Dr. Zero Trust. He has a podcast that's really fun to listen to. He is an exciting person to talk to and learn about Zero Trust from. He's literally written the book on it. So he has some really interesting ideas and perspectives on verifiable credentials and how that kind of adds to that Zero Trust strategy. So anyways, we hope you can join us for that. I put the link to the registration in the chat. I'll put it also in LinkedIn, in the LinkedIn, for the LinkedIn folks as well. But we hope you can join us for that. As always, if you have a topic that you're interested in, a perspective, an industry vertical that you'd like for us to explore, please reach out. You can find me on all the socials. I'm the only Helen Garneau, I think, unless there's other digital identities, so who knows? But feel free to reach out. You can reach me at Helen@Indicio, my email. But otherwise, have a great rest of your day, great rest of your week, great rest of your summer. And we'll see you at the end of August for a great conversation about Zero Trust. And if you have any questions about KYC or Indicio or what the demo you saw earlier, please reach out as well. We always love to answer questions and get people interested in this awesome world of decentralized identity. So with that, I will stop the share, and thank you so much all for joining us.